All right, then, guys, it's Jeff. Today's Monday. All right, so I don't think you are going to be missing much on news today because other than the fact that Elon Musk is buying Twitter seriously, and also on Twitter he's actually just going through some argument with Bill Gates. So just another Sunday something. But yeah, other than that, there isn't really much news going on. But anyway, let's just cover some news today. Nevertheless, all right, let's start with something very, very important as well, of course, which is Twitter. Elon Musk are finally in talks to strike a deal. So, of course, if you're interested to know how this deal actually went through with the whole entire thing, I have three separate videos on how this actually went through, from how Elon Musk actually did the whole entire offer, and how it actually did not go through, how Elon Musk gotten an offer to join the board of directors, and then afterwards, Twitter throwing out a poison pill. I don't think I'll be making any more videos from that end. But of course, with this sudden new revelation that, Twitter and Elon Musk might actually strike a deal. Because, Elon Musk actually did report that he has $46 million in cash ready for this deal. Okay, it's not just because he will be borrowing money or anything. It is that he has borrowed the money and he's prepared to go through with a deal. So yeah, pretty interesting. Of course, if you look at Twitter, because of what insiders are actually talking about, Twitter actually bounced all the way 4% upwards, actually, all the way to $51 at the moment in the pre-market. Of course, hitting almost a $52 high in the pre-market, which actually was about 20 minutes ago, which is quite interesting for us to really see Twitter actually going up again. But like I said before, personally, okay, not financial advice, okay, personally, I do think that Twitter is definitely going to be a sell anything below $54, simply because if Elon Musk is going to get it, if Elon Musk is going to get the company, chances are it's going to go private. And if any case of sort, it will just be that Elon Musk are just buying over your shares at $54.20. Unless, if of course, this deal suddenly changes the whole entire trajectory of the deal, where Elon Musk and Twitter is suddenly saying that maybe this deal will price Twitter at $70 instead. And if that were to be the case, or in Elon Musk form, it will be $69, 0.42 cents or something along that line. If that were to be the case, then of course, then you would definitely see Twitter skyrocket a lot more. But of course, if that were to happen, then Elon Musk will also need to have a lot more cash, because that is almost, well, I won't say almost 2 times, but that is a lot more money as compared to what he's actually willing to pay off now, which is at $54.20 per share. So of course, we're just going forward with the thinking and the mentality that, of course, the deal is going to be around that cash value as compared to what a lot of people would like to speculate Twitter to be in terms of a growth company. Mm-hmm. So yeah, over here, Twitter has been expected to rebuff the offer, which Mr. Musk made April 14 without saying how he would pay for it, and put in place a so-called poison pill to block him from increasing his stake. But after Tesla chief Elon Musk disclosed that he has $46.5 billion in financing and the stock market swooned, Twitter changed its posture and opened the door to negotiations. So like I said before, of course, if you are actually someone who is from Twitter, the moment they actually introduced the poison pill without even thinking about entertaining Elon Musk offer, I think that it would be very, very bad for the whole entire company as a whole. So I'm very happy that they are actually thinking about even maybe just posturing themselves to accept negotiations to begin with. Because like I said before in one of the 3 videos that talk about this whole entire Twitter deal, okay, the least Twitter can do is to counter, okay, give an offer $69 or $78 or $84 or whatever it is, give a counter offer. Whereas, what Twitter basically did was, we're gonna just do a poison pill. Everyone who is invested in Twitter is gonna get it. I just thought that was a very, very bad move by Twitter. That's the whole point of why the poison pill has not really been adapted in the past decade, because it is something that wasn't being introduced back in the 1980s. I don't think people have been using it for the past decade for any of the corporate action in in the recent times. So which is why I thought that it was very, very weird for Twitter to really do so. It simply just shows that Twitter is just very, very unwilling to get Elon Musk on board. But of course, by doing so, they're actually not abiding by their fiduciary duty to actually ensure that all the investors are getting the best deal that they can. So just my own thought on it. But over here, so I did think that Twitter is slated to report its first quarter earning Thursday and had expected to weigh in on the bid then, if not sooner. And I do think that this is a very, very important thing, because let's think about it from a different perspective. Okay, if let's just say in the next 2 days, okay, for example, because it's going to be reporting on Thursday. Right now it's Monday, okay? So that means, for example, if by tomorrow, which most likely would be the case, with this whole entire thing actually being out in the open, we will most likely get the answer by tomorrow, okay? So if by tomorrow, Twitter actually says, you know what, we're not going to be accepting this deal and such, it simply means that the earnings on Thursday would be something that would actually shock a lot of people, aka a surprise beat. That's my own expectation. Because let's be honest, Twitter knows what their earnings at currently, okay? They are going to report it, but they already know that their earnings are going to be good. Hence, they would most likely be like, you know what, I think that, after this earnings, if you do think that Twitter is still worth 54.20, then afterwards, then maybe you can still have a deal. But of course, at the same time, if Twitter is, looking to actually miss on expectation, that's going to be a different thing. Because, if Twitter is meant to be missing on expectation on Monday, today or tomorrow, they will most likely be like, you know what, or let's just sell the company before the earnings report actually come out. Because let's look at Netflix, okay, or let's look at Facebook from the previous quarter. Okay, a lot of companies actually went down post earnings. Okay, good earnings don't really give you fantastic results. Bad earnings destroys your company. That's kind of been the trend since the last quarter. So I do think that might be what Twitter might be actually bringing, weighing on with this current market, where they can basically just be like, you know what, maybe we can actually sell the company, seeing how it is. So we're actually turning more into a bear market as well. So of course, if that were to be the case, and I'm not sure, okay, by tomorrow, if they actually say that they're going to sell, chances are you can actually look at the earnings report on Thursday and you will see that they probably missed by 10-20% on the margin. And that would actually kind of shed some light on the reason why Twitter actually wants to sell. Just my own thought. All right, anyway, let's not harp on this any longer. Wall Street finds new value in cash as global fears weigh on market. All right, so of course, with geopolitical tension in Ukraine, China's COVID-19 outbreak, which is a huge issue, okay, is a huge issue even for the S&P. Today, they're actually down 0.6%. And of course, earlier in the pre-market, it was actually down close to 1.2% as well. Pretty crazy, okay? And it's also because of the whole China COVID sudden outbreak. A US or European recession and surging global inflation are making a long-span asset increasingly popular with Wall Street top money managers these days. Cash. Of course, okay, I'm not going to be talking much about this this article, but I just wanted to bring forth this the topic from this article, which is how people think that cash is definitely going to be better in this kind of market. And personally speaking, I don't think that is going to be the case, especially with how inflation is literally the most used buzzword in the previous, 2 quarters. Okay. Today, just earlier today, Singapore also reported 2.9% on core inflation, which is pretty high. Of course, this is like in the past decade, one of the highest inflation that we actually had. And in Singapore, it's very, very hard for us to really go higher than 2% in terms of inflation, because the thing is that the government actually tries their best to put a cap on a lot of pricing to ensure that consumer prices do not go out of hand. Okay, so for our own inflation data to actually go over 2% is actually quite absurd. Okay, but of course, let's just not look at just Singapore alone. Look at the United States, 8.5% global. Okay, look at the UK, 6 or 7% global. Okay, look at China, they're doing 4 to 5% in the inflation rate as well. So of course, this is not just a small country sort of thing. This is happening in every single country. Okay, the whole entire world, whichever country it is. Okay, 2 years ago and compared to what we are today, inflation is definitely going to be up no matter what the country is. And because of this whole situation, I don't think that holding cash is I don't think holding cash is the way to go. Okay, as much as I believe in people saving money, okay, for rainy days, okay, emergency funds, fair enough. But if you're talking about saving a huge chunk of your money away, I don't know. I do think that you would definitely need to have some form of a investment tactic, and pass it over to a financial advisor. I'm not a financial advisor, okay, so I don't think that this is going to be skewed towards me. Okay, I do think that you should definitely be investing your money. You don't know how to invest, get someone who knows how to invest, because if your money is going to be rotting away in your bank account for a Singaporean at 2.9% a year, come on, man. I just think that eventually your money is just going to just go to waste. And of course, if you really do not know how to invest and you refuse to get someone to invest, just get into the index funds. Okay, just look at the SPY. Okay, the S&P 500. It's true that they're down 2% on Friday, well, to almost 3% on Friday, and they have constantly been going down as well. But even then, as they have been going now, right now they are actually hitting $420, which is kind of a very, very strong resistance line that hasn't really been met in a very, very long time. Of course, I do think that this is one of the reasons why people are also thinking that the S&P is also getting into a bear market, which would also be one of the news article that I'll be going through later on. So yeah, I don't think that cash is definitely going to be like the best asset for you to really hold in terms of a current bear market cycle or a recessionary fear. As much as ultimately the short-term recessionary fear will definitely require you to have cash, but you holding on to cash going into a recession makes you feel that you are ultimately right, and you're going to put cash on a pedestal, and you're not going to invest because you're going to think that cash is so important through a recessionary trend, and you're going to be crippled with your own decision that because you made a good decision by holding on to cash through a recession, and you're not going to invest your money post-recession. I think that is going to cripple your decision for investing for the rest of your life. I think that's going to be changing your entire mindset. So yeah, that's just my thought on that. All right, anyway, let's move on. I don't want to waste too much time. I think that because there's not much news, I kind of don't want to delay this any longer. Anyway, Bitcoin falls to a 6-week low as risk-off mood gathers momentum. So, of course, if we're looking at Bitcoin right now at $38,700, Ethereum at $2,800, Dogecoin at 13.8 cents, if that matters. Cardano at 85 cents, which is quite crazy because Cardano actually had a huge rise up to about $1.20, and afterwards kind of just cooled off completely. Kind of scary to see this huge momentum. Of course, with Ripple as well. Ripple surprisingly actually taking over a few of the strong names in the crypto market. Okay, even Solana has actually dropped off the top few coins with Ripple taking over as well. As much as a lot of people are talking about how Ripple is a scam coin and such. Kind of interesting to see how a lot of the markets is kind of moving around. But yeah, I do think that in a risk-off market that we are at the moment, it's not just going to be your cryptocurrency. It's going to be your growth stock. It's going to be your tech stocks. All these kind of companies and assets that you're going to be looking at are going to be going through a very, very tough cycle. Of course, which is why I think that, of course, most of my portfolio right now is getting beaten up. And it's not something that I have not really expected either, which is why on Friday, I think I made the correct move of actually, well, it wasn't just Friday, it was actually on Tuesday that I actually made that move, and I just announced it on Friday, where I actually recalibrated my entire portfolio, where all the risk on risk-on asset, I basically just sold them all, well, or at least up to 95% of those risk-on asset. I did sell them off, and I am actually holding on to a few better value positions, where if it actually comes down to it, I will actually sell those value positions and actually get back into those risk-on assets. So of course, those risk-on assets can be anything from your Hippo, your Lemonade, the AMC and such. So those are the risk-on assets that can most likely go 10, 20 times. But at the same time, during a bear market cycle, they're going to continuously lose money. I'm not sure if I made the correct call, but that was what I did. If you're interested, go over to the Friday news, where I actually explain my weekly trades. You can hear more about it over there. All right, so afterwards, let's talk about this, which is U.S. aims to weaken Russia in Ukraine, where Austin says in the Kiev visit. Okay, so over here, the U.S. announced additional military aid for Ukraine as Defense Secretary Lloyd Austin said that Washington wants to see Russian forces ground down so they can attempt a repeat of the war. Speaking to reporters in Kiev on Monday during the highest level U.S. visit to Ukraine since Russia invaded 2 months ago, Austin and Secretary of State Antony Blinken committed to a total of $713 million in foreign military financing for Ukraine and 15 allied and partner countries. Some $322 million of that sum is earmarked for Ukraine. With the war now entering a third month, despite several rounds of international sanctions and waves of weapons supplied, Austin was asked about U.S. goals in the conflict. Washington wants Ukraine to remain a sovereign, democratic country able to protect itself, and we want to see Russia weakened to the degree that it can't do the kind of things that it has done in invading Ukraine. So, of course, like I said, geopolitical tension has always been a thing since the 24th of February. And of course, with what actually happened with Mariupol, where Putin basically just came out and said that Mariupol has been successfully liberated by the Russian. I do think that a lot of the neighboring countries are going to be very, very angry with this whole situation, which is why clearly the reason why US actually came up with this whole sudden $730 million in foreign military financing for Ukraine. And of course, I do think that they want to ensure that Mariupol is not going to happen again. But I do think that at the same time, as much as the US is trying to give out some all the additional financing to Ukraine, it's still not going to be helping Ukraine enough for them to really win this war per se. And because of that, it's just going to be a long drawn out occupation. Right now, looking at Occidental Petroleum, which is an oil company. Right now they're down. They are down about 4%, and I'm guessing that oil prices is also down. Let me just take a quick look. Let me see if I can. Yeah. Okay. It is down a little bit at about $97 right now. So yeah, it's good to really see oil prices kind of coming down a little bit. So that's fine. But yeah, I do think that ultimately. The whole geopolitical tension is definitely going to be something that we have to worry about for the next few months at least, I guess. All right, S&P 500 ready to join the bear market, says Morgan Stanley. This is going to be the last news. So anyway, with defensive stock now expensive, few places to hide at Morgan Stanley. Strategies aside tightening Fed and recession woes. So on Saturday, I actually uploaded a video talking about how the whole FOMC is going to actually go. I'm not sure if you guys have watched it yet. If you guys have not, just go over to my channel. It's the latest video right before this one, where I posted on Saturday. I actually explained my own expectation for the FOMC meeting that's going to be happening on the 4th of May. Okay, I do think that that's going to give you a little bit more insight of what is going to be happening on the 4th of May. So pretty interesting. All right, so over here they're talking about the S&P 500 about to drop sharply. Okay, and by sharply, we have to also understand that the S&P, okay, in that video that I talked about, I actually explained how the S&P has actually been dropping quite consistently in the past week, especially after Jerome Powell talked about the possible 50 basis point increment. Of course, that's going to be something that's going to be cited by the Morgan Stanley strategists, because clearly there's going to be a very, very huge part of why the S&P is constantly going down. All right, so S&P 500 index has slumped for 3 weeks in a row, sinking to the lowest level since mid-March on Friday, as investors fled risk asset amid fear of a rapid monetary tightening, which is something to do with the Fed, and its impact on economic growth. Chairman Jerome Powell's endorsement of the aggressive action to curb inflation sent traders racing to price in half percentage point interest rate increase at the bank's next 4 meetings. Of course, this is not even the worst, because with what Jerome Powell is talking about, he's talking about a 50 basis point increment. However, he's talking about how the economy is going to be able to handle a 50 basis point increment. But you're not even taking into the consideration of a 75 basis point increment, because that is very, very possible. And if inflation continues to go up in the next few CPI readings or the next few PCE readings, which is what the Feds like to use, I wouldn't really take away the possibility of a 75 basis point increment. And that's going to be where the real shock to the economy is going to come about. Of course, I don't think that Jerome Powell is going to come out to talk about it. But that is definitely going to be shocking the market, which is why on the 4th of May, it's going to be a very, very important date for us to see if it's going to be a 25 basis point hike or a 50 basis point hike. Of course, if it's a 50 basis point hike right now, we're clearly seeing how the market is trying to price in the whole action, where a 50 basis point hike is already happening. So, of course, if we do see a 25 basis point hike, we're definitely going to be seeing some form of a rally happening in the market. And of course, if we do see 50 basis point hike or even a 75 basis point hike, I would like to think that the SPY would most likely drop below 420, even 410 or even $400. And that's kind of my concern. But anyway, that's all I have for today's news. Anyway, thank you so much for watching, and I'll see you.